Welcome to the investment meeting for October 2014. Let's quickly go around the room, introduce ourselves for the record.
Good morning, everyone. Rosemary DeBellis, designee for Police Commissioner Bratton.
Barry Dennis, SAS. Dan Torelli.
Consultant to the Board of Trustees.
Dan Torelli, PBA. I have the proxy with the chairman of the board, Al Lacerda.
The new chairman of the board for this year that will be serving from October 1st through September 30th of next year, Al Lacerda. So Joe Alejandro, representing the PBA, having proxies of Patrick J. Lynch, John Puglisi, and Mubarak Abdul-Jabbar.
Chris McGrath, PBA, Associate General Counsel, by invitation.
Bob Ganley, SBA, proxy for Ed Mullins, President.
Designate.
Designate.
Lou Carabetta, proxy for Lou.
Designate. Oh,
Let me do this. Lou Carabetta, LBA, proxy for Lou Turco, LBA.
I knew this was going to get screwed up by the supervisors.
Chris Monahan, proxy for Roy Richter, CEA.
Michael Palladino, DEA. Sometime during this meeting, I will be departing, giving my proxy to Joe Alejandro from the Patrolmen's Benevolent Association. Reason for my departure is the death of one of our detectives, 9/11 related.
Bob North, actuary.
Present by invitation.
That sounded good.
Scott Evans, Chief Investment Officer, Controller's Office by invitation.
Susanna Vickers, Controller's Partners Designee.
Antonio Rodriguez, designee for the Commissioner of Finance, Jacques Jihan.
Who did not take our advice at the last meeting to get out of town.
And you also have a proxy today, correct?
Justin Holt, designee for the Mayor's Office.
Bob Sanskisted, Pension Fund, by invitation.
Kevin Holleran, Pension Fund, by invitation.
Martin Gantz, Controller's Office, by invitation.
Wesley Pulisic, Controller's Office by invitation.
I'm Don Glenn, Controller's Office by invitation.
Castro, Controller's Office by invitation.
Alex Donier, Comptroller's Office, by invitation. James Delgadio, Comptroller's Office, by invitation. Kevin Monson, Comptroller's Office, by invitation.
Nicole Jambrisi, Counsel for the Police Pension Fund, by invitation.
Okay, thank you, everyone. Scott?
Okay, thanks very much. Today,
Scott, I'm sorry, could you give me just 1 minute? I just
Yes,
want to
sir.
report. I've been asked to sit on the committee to select the next actuary for this, on behalf of this fund. Now that Bob's here, Bob has an understanding of what is going on, but I feel it's necessary to let everybody on the board know what's going on. But, the committee has met twice already. We've discussed the process. We will have, we're in the process of calling members who we would like to be at a blue ribbon panel to assist us in vetting out potential candidates down the road. And that's where we're at right now. We're hopefully going to meet with one of those members of that potential panel at the next meeting. And if we could get that person aboard and maybe one other, then we can start potentially putting out an advertisement to invite people to apply for the job. That was remarkably well done by Mr. North for many, many years. You don't know how much that hurt saying that, Bob. I'm sure you're going to try to play that. And that would be, hopefully, we will not take the 3 years it took the last time before we hired Bob North to be the actuary. So, and that's the update. Thank you. I'm sorry, Scott.
Okay, thanks very much. Today, we're going to very quickly give you a monthly report for August. There'll be a SIS performance review, a skim discussion in the public agenda, and then our executive agenda is packed. So we will try to get through that as quickly as possible. August was a good month. It seems like a long time ago now because a lot has happened since then, but we're here to report on August. 2.43% for police total. That's on page 39 of the color book. and that's versus the benchmark of 2.2. So it was a decent month, picked up a little bit on the benchmark. The markets continued after August to be very choppy. September was a weak month. August was no picnic either, or October was no picnic either. Martin's going to take you through some of the drivers of that, and I'll come back and talk about rebalancing. Remember, here we have a long-term asset allocation. We're trying to stay close to that asset allocation, rebalance as we go through choppiness. As in a directionless market, rebalancing is our friend. It helps us to buy low and sell high when we allocate. And while we can't predict the short-term directions of the market, if we stay disciplined, stay consistent, and focus on good managers, we should continue to pick up ground versus the benchmark. With that, I'll turn it over to Martin to take you through some of the economics.
Thank you, Scott. If you turn to page 15, I'll start there. The market, as Scott indicated, has been extremely choppy with more volatility than we've seen probably since the summer of 2011. You'll see on page 15 it's a chart of the dollar index. The dollar has significantly strengthened over the last few weeks, as you see from the far right part of the chart. This has been a bit of a puzzle before. Generally speaking, economies with higher interest rates and higher growth prospects have stronger currencies. There are obviously other factors involved. That's a simplified version of this. And it has been a bit of a puzzle as to why the US dollar wasn't strengthening versus other currencies. Well, now it is. Part of that strengthening is because of not necessarily the strength of the dollar, but the weakness of other, perceived weakness of other currencies. In fact, if you look at the next page, we have a chart of the euro, US dollar. The euro had been really persistently hanging in the 135 to 140 range and is now down into mid-120s. And by all accounts is expected to go lower, especially since they're several years behind us and have much more problems in their economic current conditions than we have in the US. If you take a look at the VIX on page 18, when we printed this up, markets have been moving so fast, this is now outdated. On page 18 you see the VIX was at 17 and nearly 18. This is a so-called fear index. The VIX was for quite a long time, for several years, at very low levels. You see it bottomed out at 10, which is even historically is a very low level. The number now is in the low 20s. So over the last few months, it's actually doubled. This is an indication, and while it's a lagging indicator because it occurs when markets are going down, it's an indication of fear in the market right now. And as you see from the prior highs, it can go a lot higher as the market goes down, if the market does go down. When I say market, I mean the S&P 500, which is what this is referring to. Treasury, so where's the money going? This will show you markets went down, the money went somewhere. If you turn to page 20, you see the 10-year Treasury rates. Again, at the time, markets move so quickly, this is old news already. Just a week ago, it was 230 on this chart. Now, it actually went below for a day, 2% last week, and sort of ended up at 215 this morning. I believe it was about 220. That's where money was flowing. Even though the Federal Reserve is ending the quantitative easing program, which is bond buying program, so by simple supply and demand, you would expect rates to go up, but because investors are selling equities and are concerned about prospects of risky assets, they're parking, at least temporarily, their money in treasuries. Next page also, high yield investment grade spreads. You can see the tick up on page 21. If we were to run it today, it would be even higher, the spreads. That's ultimately good. It's bad because you take the capital loss today, but it's good for reinvestment going forward. High yield truly does become high yield. High. The word high actually means something in terms of yield. I'm going to skip to what happened in August. As Scott mentioned, if you turn to page 27, August was a good month. Take a look at the column all the way on the left. You see some really nice positive numbers. The Russell 3000 up 4.2%. EAFE was flat, down 15 basis points. Most of that was currency related, actually. Not that stocks were doing badly. Emerging markets was up a strong 225. And as you go down the list, everything was doing well. Core plus 5 up 139. high yield was up 168, bank loans were up, tips were up, convertible bonds were up 3.5%, REITs were up. So August was a good month, and when you put it all together, as Scott mentioned, the return for the month, which we do show you on page 31, was 243, and since it was a down July, of course, the fiscal year-to-date return up to 129. But if you turn the page after the August numbers, if you turn the page to 29, which is the very next page, while we don't have the September results for the system, September was not a good month. Russell 3000 in the first set of columns for the 1 month was down 2%. You see virtually negative numbers for all of the 1 month numbers except for hedge funds and treasuries, treasury bills. Emerging markets was down 7.4%. Core plus 5 was down 88 basis points. High yield was down nearly 2%. Even bank loans were down 0.5%. Tips were down 2.5%. So September was a bad month. So when you take it all together, if you take a look at the next page, page 31, through August, the fiscal year-to-date return, and I'm looking at the middle chart, the middle bar, I should say, was up 129. We probably lost that 129 and maybe a little bit more. So it's hard to say exactly what those numbers will shake out. We'll have them. We haven't gotten them from the bank yet. It's any day. We'll have it for you in a few weeks for the next meeting. But the number's a negative number somewhere in the 1% range, probably. Next page, page 32, shows where the asset allocation is, and I'm going to turn it over to Scott for that.
Yeah, there's not a heck of a lot to talk about, and I'm not anticipating going forward that there will be a lot to talk about here. Our goal is to keep this as close to zero across the board as possible. We have some anomalies in the market today. You're just not getting paid for taking long-term risk in the bond market. That's the dark blue. And so we're down towards the lower end of weights there. We've made up for it by being overweight in gray all the way to the right, what we call as cash. We're actually in short-term bonds, 2 years or so. We're not making much there, but we'll lose less as interest rates go up than if we're holding core plus 5. We're also underweight tips where they're negative real rates, and we're not getting paid for the risk there either. We're working down the equity overweight. We were up at maximum levels earlier in the summer. We were able to get down to about half weight before the market cracked at the beginning of August. Right at the end of July, we were able to get some money out. So at the end of August, we're sort of about half overweight in equities. So we'll continue to chip away at that when we're presented some opportunities, both within the equity market and then across the aisle in fixed income. Martin talked about the spreads. As you see those spreads come up and we start to get paid to take credit risk and other types of risk, particularly in the fixed income market, that provides us opportunity to put some of the market there. But we're not big tactical asset allocators. Our asset allocation game is rebalancing, and you can expect us to do that consistently, and the little tweaks I'm talking about are inside baseball. With that, I'll turn it back to Martin.
So I have two brief comments on the very same page. Because this is as of August, and the markets, as we showed you in September and October to date, have been down, those underweights for the blue in the middle, blue and light purple for core plus 5 and tips, which were actually beyond slightly the edge of the rebalancing ranges, because the equity markets went down, the denominator effect took hold, and so we're well within the rebalancing ranges now for core plus 5 and tips. The market took care of that. The second comment is related to what Bob North's going to be talking about in just a little bit in public session about the skim. So the skim payment from police to the VSFs will further help put everything in balance as well.
Provide this kind of a one-time opportunity to get fully in balance.
Right. Page 34 shows the asset allocation in dollars, percents, ranges, every number that you want. I'd be happy to answer any questions that you have about that. As of August, on page 37, the market value was a new all-time high, $34.5 billion. That $20 is a new all-time high. Page 34 was the one-year number, so you see month by month, and page 35 is the 10-year fiscal year return plus the last month, and you see the 10-year return on the bottom is an even 8%. So as of August, the 10-year number actually met the old actuarial rate, which is why we're talking about a skim. Following that are manager results, individual managers shown versus the benchmark, pluses and minuses in red and green. And following that, at the very end, are the private equity positions and real estate positions as well as the cash flows. And that's all I have for now on this, unless you have any questions.
I just want to repeat that the fund met the old actuarial assumption rate of 8%. So it just, thank you.
On the nose.
It's interesting how numbers, when you have a particular starting point and ending point,
Right.
often tell an interesting story.
Yes, they do.
But the past is no guarantee of the future.
That's what they tell me all the time. I just happen to be right so many times. It's incredible. Wow.
Revel while you feel like it.
Okay, so that does it for the monthly performance review. I think we'll turn now to SIS for their performance review. Oh, there it is, down there.
This starts on page 73 in the big books. This is something that we do once a year using June numbers. And we're trying to look at longer term and shorter term performance, rolling 3 years, and focusing on relative and risk-adjusted returns, both to the benchmark and 2-year peers. You'll see on page 73 that the peers are defined as public funds with more than 10 billion. It's a fairly small sample, 13 or 14 such funds in our database. So the point is you can move around a lot with small performance differentials. Then we look at 4 individual asset classes: U.S. equities, fixed income, developed markets, non-U.S. and emerging markets. And here we have very robust universes, and the returns both for the system and for the peers are all gross of fee. When we look at the policy index, it's the adjusted policy. We also present something called the allocation index, which is a hypothetical number if you were invested in passive funds at your actual weights versus your benchmark weights. This gives you an idea of how being different from your policy weights, adjusted policy weights, affects returns. In other words, your timing. And other than the total fund, we're just looking at the publicly traded asset classes, not the hedge funds, real estate, or private equity, but those returns are included in the total. So this is the 3rd time I've done this. The results started out as being quite good, and now they've gotten very good. When I read in the New York Times the criticism of the performance of the pension funds, I have to scratch my head and say, what are they looking at to reach that conclusion? Because this certainly refutes that. I'm on page 74 now. Your cumulative ranks over 1, 5, and 10 years are what I'd call top quartile. The 3-year number slips a little bit. The asset allocation index exceeds the policy index over all the cumulative periods, which says, on average, your timing has been good. And that's been really propelled in the last 2 years, where you've been at the bottom of your range for tips and core plus fixed income, and at the top of your range for equities. That's been a very powerful decision. You're neutralizing that now, and I agree entirely with both the step out and the step back. Rolling 3 years are probably the best way to look at performance, and your rolling 3 results over these periods that I'm looking at 7 overlapping 3-year periods, never gets worse than median. That's a good result, consistent result. And your last year was a great year, beating your policy by 80 basis points. That's huge. Okay, I'm on page 75 now. These are the total fund ranks, and again, with the exception of the 3-year rank, which is at 47, everything else is in the top quartile. The allocation index at the bottom versus the policy index, There's value added of 70 basis points over the last year and 70 basis points over the last 3 years. That's huge. People would kill for that kind of outperformance. So a very good cumulative rank. On page 76, the rolling 3-year periods, as I said, nothing below median. I'd also point out there's 2 periods there from 07 to 10 and 06 to 09 where the total results are negative. In those 2 periods, you beat your policy index. And if there's ever a time where it pays to beat your policy index, it's when returns are low. That helps to stabilize the overall result. So that's good. Let's move on to the U.S. equity portfolio on page 77. A very good year in fiscal 2014, beating your policy index by 50 basis points and just shy of the top quartile. Longer returns are about median. And all cumulative periods exceed your Russell 3000 benchmark. Last fiscal year, the small cap overweight helped. This year, it was neutral. It was a mixed bag. We got outperformance versus large cap in the mid cap sector, but the small cap sector underperformed. And small cap is going through a very rough period now, and again, that bet is being neutralized. We had 4 managers that carried the day, Zevenbergen, and then in mid cap, Frontier, Iridian, and Wellington were all superior performers. When we look at your information ratio, and this is the risk adjustment that I'm making, and that's your active return divided by the standard deviation of your active risk, it's around the top third. So your risk is being managed intelligently. You have very low tracking errors in U.S. equity, and I think that's a good thing. And the database numbers will show that this is really a tough area to beat the market in. Probably the toughest of all that we're investing in. On page 78, you see your last fiscal year puts you in the 28th percentile, and results are above median out through 5 years, and a little bit shy of the median, 10 basis points over 10 years. This portfolio is dominated by a passive approach. So you would expect you'd come close to your benchmark. In the last year, you can see the median manager at 25% return underperformed the index at 25.2. So not a great year for active management, but a great year for the system. The 3-year returns on the next page, page 79. Again, we have results that tend to be above median. 2 periods fell below the 50th percentile. We have 7 3-year periods on this page. The system have 1 in 4 of them. They've lost to the benchmark in 2 and tied 1, so a pretty good batting average. The information ratios are strong. I characterize them as top third, so that small amount of active risk that you're taking has been well spent. And you can see on page 81 that your active risk is very small relative to the universe. Basically, you're taking less active risk than 90% of the pension funds out there. Fixed income, starting on page 82, is once again the star of the show. Strong results continue. They're top quartile and beating the pants off of the benchmark. And really the excellence truly coincides with the initiation of the opportunistic fixed income portfolio, which has both been well-timed and well-implemented. I would characterize your risk-adjusted returns, your information ratios, as top 10%. When you combine good risk management with median-type risk, you get a very powerful combination of relative returns versus your peers, and that comes through. And this includes all your fixed income. So on page 83, you can see these returns are basically top quartile. But look at the spreads over the benchmark. 220 basis points Last year, 290 over 3 years, 220 over 5 years, and 160 over 10 years. Those are huge numbers for fixed income, which is supposed to be a less volatile asset class. The 3-year rolling periods, there's only one there that falls below the median at 57, way back when. But if you look at the last two, which is really where we're capturing the initiation of the opportunistic fixed income, they're well into the top quartile. And then if you look at pages 85 and 86, you'll see what I mean. Your information ratios are top decile, and you're taking median type risk. And those two in combination are very powerful in propelling your cumulative ranks into the top quartile, which is what we saw. The international developed markets starts on page 87. The results are closely match the index returns over cumulative periods, despite a lot of active management. There was an effort made in the reconstitution of this portfolio to get more active risk into the portfolio. And you see at the bottom bullet on this page that seems to be taking place. When we looked at this last year, your tracking error was under 1%. And when we add on the last year, it goes up to 1.5%. So that seems to be working. I will say international managers, developed markets in general, had a very tough time beating benchmarks in the fiscal year. You'll see when we look at the next page that they underperformed EFA by 1.5%, which is big. My general observation is these managers got two things wrong. Number one, they dabbled in the emerging markets despite their benchmarks being EFA, and that was very painful. Number two, if you look inside of Europe, the worst performing countries were the most economically strong. So Germany was one of the worst performers. The best performers were the weakest countries in the peripheral. The Greece is no longer in the index, that got kicked out. But Portugal, Italy, Spain, Ireland were some of the best performing markets in Europe. And again, the managers got that wrong. And that explains their shortfall in fiscal 2014. The overall results were 20 basis points behind EFA for the fiscal year, but ranked in the top half of the sample at the 30th percentile. And that gives you an idea of what I'm saying, that most people didn't do very well in this last year. Our results were held back by Thornburg, which had a very poor year. They've since been terminated. And we had some offset from Bailey Gifford, who had an exceptional year. So moving on page 88, you can see it was a 30th percentile year, bringing the longer-term cumulative results close to median. The 3-year returns tend to hug the 50th percentile, some a little bit better, but most of them a little bit worse. Like I said, we do have a new roster here, and that roster seems to be working, at least against peers, better than the former. And I mentioned the tracking error did go up, which I view as a positive, especially given the confidence we have in our new managers. Emerging markets finally came out of the doldrums. They returned 17% in your portfolio, 14 for the benchmark. But what a great active year for your emerging market managers. Beating the benchmark by 300 basis points is huge. And you were hitting on all 4 cylinders. Each one outperformed their benchmark. Active management is showing some rebound, and active managers hadn't been doing well in emerging markets, but the last 2 years they've sort of made a very strong comeback. You have 75% in active strategies, 25 passive, and that just speaks to a very strong structure that has been put together. And I would point out your information ratio, the management of your active risk, if you look at 1 in 10 years, is top percentile. Can't get better than that. So the emerging markets begin on page 92, a 10th percentile fiscal year, very good. And the 10-year result is in the 13th percentile, beating 87% of your peers. The information ratios are strong. I mentioned top percentile in 1 in 10 years and 14th percentile in 5 years. And your tracking errors remain small. Maybe we should take some more risk here because we're doing it so well. But all in all, a very good report card. Happy to deliver it. Any questions?
You call the New York Times? Take it also? Apparently it's better to report lies than the actual truth.
Maybe they're watching.
We should only be so lucky.
Their source was the National Enquirer.
Yeah.
Okay, Bob?
Yeah, so we have
Oh,
Bob
sorry.
North to talk about this. Good.
Yes, thank you. I have a memorandum to be distributed, if Mr. Sunskestev would be so kind.
Bob, are we going to speak of this in the executive or the public session?
This is public.
Public.
I'll do this one.
Thank you. What I plan to do today is talk a little bit about something that hasn't occurred since 1996 for the Police Pension Fund and the Variable Supplements Fund. And that is that there will be transferable earnings, often referred to as SKIM, from the Police Pension Fund to the Variable Supplements Funds. This memorandum you're receiving today is one that does multiple things. First, it goes over and shows you a little bit about how it's estimated. And the estimate has been made earlier than in prior years, both for the benefit of getting information into the city's financial statements and because people thought it would be good if I were around to talk about it, since I institutionally may be the only one, maybe Joe remembers. I mean, it's been a long time. So this memo consists of multiple parts, as I say. First of all, it's just an overview of what needs to be done. There's some background. And it requests actions on the part of the board. Amongst those are, you are required to adopt the hypothetical interest rate. In order to determine this number that we've referred to as transferable earnings, the Comptroller's Office each year keeps track of earnings on equities, and to the extent the earnings on equities exceed what those assets would have been invested in and earned this hypothetical interest rate, that creates either a surplus or a deficit. The last time we had a surplus was in 2000. There were limits and reasons why it could not be transferred to the variable supplements, but since then, a deficit developed in 2001, fiscal year 2001, and until fiscal year 2003, the cumulative deficit continued, and hence there was no potential SKIM. In fiscal year 14, thanks to the very good investment performance in equities, the cumulative deficit has been overcome, and there is a potential transfer of earnings.
Bob, you said before 2003
I meant it's the deficits continued from 2001 through 2013. So if I said 3, I apologize. So we had an extended period where the deficits just accumulated due to poor equity performance. So in fiscal year 14, we now have a potential transfer of earnings. So the memo, when you get to page 3, requests multiple things from the board, starting with the adoption of a hypothetical interest rate for fiscal year 2014. Then second, the adoption of the hypothetical interest rates from 2001 through 2013. Given that there was no real discussion to be had because there was no potential transfer of earnings, we just didn't come to the board and ask for you to do anything on this issue. And so it is a requirement that board adopt the hypothetical interest rates. Now, the hypothetical interest rate you're using is 115% of the average U.S. Treasury yields on a monthly basis from Federal Reserve Bulletin H15. The board adopted that in a resolution on March 14th, 2001. The reason it was chosen is previously, I think for a couple years, we'd used 112% of the 30-year treasuries. And before that, it was a Solomon AA index. Well, in order, first the Solomon AA index went away. Then the government quit issuing 30-year treasuries. So we finally went to something where we reviewed all the possibilities and concluded that the closest to meeting what had historically been done with something that we thought would continue was the 10-year treasury. And we've had 10-year treasuries throughout the period, and so it's not an issue. Then the board, the actuary requests that the board authorize the transfer of 90% of an estimate. Now, the reason that the estimated amounts, first, they're not final because they can't be final, because we can't figure out exactly how much we made until all the numbers are done. Second, we can't figure out the allocation between the police officers and the police superior officers until the June 30, 2014 census data is final. Under the one-year lag methodology used by the actuary, that data will not be final until all contracts are settled, or basically the end of fiscal year 2016 is upon us. So it's going to take quite a while to finalize to the dollar the numbers. This is an approach we've used in the past. We make some estimates up front, and then we ask you to transfer 90%. The allocation is based on member contributions. We hadn't yet finished the member contributions, so we use salaries. There's a good chance the percentages could be off by 1 or 2% in either direction. Because of that, a 10% cushion gives some flexibility in hope that, one, we got pretty close, but if we didn't, there's a little cushion, depending on where things go. Of course, we've also had the problem in the past where even at 90%, it was too much, in which case we took it back. But again, these are mechanics, and the important thing is that there's actually money to move. This is of particular import, I know, to the police superior officers who, although under Chapter 3 of the laws of 2013, we make sure that money is put into the fund to pay the benefits every December. This will now allow for the traditional transfer of earnings from, quote, excess equity earnings to allow for the money to be there to pay the benefits this December and for maybe several Decembers to come. So finally, at the very back, let me highlight just one item here. If you go into enclosure A, is actually a rough idea of where the numbers come from, and you'll see basically that we try to make an estimate. We started with the June 30, 2013 deficits at the point in time that were the best that the controller had, and those continue to be reviewed because it's been a lot of years, and although the controller's office has done yeoman work every year, trying to keep this largely unused item up to date, they're now doing additional reviews, and so they're going to make absolutely sure it's right as of 13. They provided some additional information, and the actuary made this estimate as a 14 in order to bring something to you. We then allocated it according to salaries. We know that's not going to be right or final, and then first rounded down the allocation and then took 90% as the recommendation to the board. The full numbers will show up in the financial statements of the city, the police pension fund, the police officers variable supplements fund, and the police superior officers variable supplement funds as accruals as of June 30, 2014. So finally, if you go to Appendix C is your draft 5-page resolution that has lots and lots of whereases with lots and lots of references to portions of the administrative code. I think I got them right, but if not, I'm sure Nicole or someone will correct me. I suspect you guys will check it out. But that's partly to give you some of the history and the whys and the wherefores. And in there, then you get to the resolves, which are, as I say, adopt the hypothetical interest rates, and then directing the transfer of monies first to the officers and then to the superior officers. And finally, directing the actuary's office to finalize all the numbers once it's possible so that you all can settle up everything. Now, I'd observe a couple of things. You don't have to, and probably shouldn't necessarily vote on this today because you're just getting it today and you should chew on it. I would encourage you to vote on it maybe at the next regular board meeting where that will give enough time for working with the controller's office to have, and presumably with the investment consultant, to consider what is the most efficient and best way to do this. In theory, this could be transferred in a lump, but you will want to minimize expenses and so forth. You want to make a smooth transition, and I would suggest that you defer and take advice from the CIO and the controller's office on how best to transfer the money over. The only thing that I say that is fairly certain is just to be sure you get enough money to pay the December payments into the police superior officers. I think they would like that. But hopefully this will set forth. Now there are two other letters, one individually for the police officers VSF and one individually for the police superiors that I just could not get produced by the time of the meeting this morning. In there, you will be given a resolution requesting that you adopt actuarial assumptions on the recommendation of the actuary to determine what we refer to as the ABO gate. There is a limit to how much can be transferred from the variable supplements fund. It's equal to the accumulated benefit obligation minus whatever assets exist in the variable supplement fund. We've done the test. It's not going to affect you this year. So everything that is, quote, excess earnings is transferable. However, it will be important for the boards individually, after you've seen the letters and you've reviewed them, to also look at and hopefully adopt those resolutions at the same time you adopt this, and then that ties together all the different components for this financing of the variable supplements fund under the original traditional as modified approach. So that's my spiel, and as I say, because these are fairly big numbers, and there are a lot of assets involved, and both for the benefit of the police pension fund and the individual variable supplements funds, I encourage you to work closely with the controller's office for the most efficient transition of assets to keep expenses down and so forth. And I would argue, although statutorily, quote, this is supposed to happen by December 31st, that you try to do it as quickly as possible, but not quicker than works best with the investment parties acting on your behalf. And so that's, any questions?
We're gonna get out of here that easy. So, just a question of, on, I guess, page 3 of your memo, you say fiscal year 96, there were certain calculations that were made every year since 96. Was there any difference in calculations between 96 and, after 2001, you show a cumulative deficit. What was happening between 96 and 2001?
Okay. Fiscal years 1997, 1998, 1999, and 2000, there were potential skims, all of which were limited by the ABO gate.
Oh, so the
And
ABO
hence,
gate
no
kicked
money
in.
was transferred, even though there was a potential transfer. Equity earnings did very well in the late 1990s, but you all were not able to receive transfers to the variable supplements fund because the, quote, ABO gate, unquote, came into effect.
And in 2001, was that when you started doing the value of potential skim and added that on to the annual bill to the city?
I think let me break that into two parts. The first part is every year since 1996, the controller's office has accumulated estimates of what a potential skim could be. The actuary's office did the ABO gate, and from 1996 through 2000, basically there were no transfers. Starting in 2001, a deficit was created, so there was a negative potential skim. And that remained that way until this year. So the numbers have been worked on, not absolutely signed off and final, but they've been worked on sufficient that I felt comfortable giving you something here. But I think your question is getting to the point of how does this all get financed from the point of view of contributions from the city to the police pension fund. Since in 1990, the long-term expected rate of return for the 5 New York City retirement systems was set at 9%, but a discount rate of 8.5% was recommended and adopted for police and fire. The reason was that it was estimated by the actuary that upwards of 0.5%, that may have been a little too conservative on my part, in the sense that maybe it should have been more, 0.5% would be used as money that would be transferred to the variable supplements fund. So we lowered the discount rate to account for it. Starting in 1990, fiscal year 96, the actuary switched to the liability valuation method, by which time all of the variable supplement funds had moved to a defined benefit structure, and the actuary included the present value of all defined variable supplement funds benefits in the liabilities in the calculation, and netted out the variable fund assets, called it the present value of future skim, and used it as an obligation in financing the police pension fund. So basically since 1991, the actuary's assumptions and methods have been designed to set aside in police funds sufficient to build up to when a year like this might occur where you have to transfer money over to the variable supplements fund.
Now, given that explanation, in essence, it was pre-financed in a way, this skim, somewhat, and over time has built up in the funds itself, and so now we'll come over. There is a savings here, right?
No.
And there's a savings for the city over time. You're saying no?
No.
If I pay something ahead of time and I now have to pay it up, then there's a savings, is there not?
The term savings.
I know
think
you.
is negative deferral.
Nomenclature here. Let's just get it. Let's put it this way. I see savings. You may not see savings, but there's a savings.
Each year when the actuary does the actuarial valuation of the fund, we take into account the status of the assets and liabilities of the variable supplements fund. To the extent the variable supplement funds are short, we ask the city, in effect, to contribute toward that as part of building up the assets of the police fund for a day like this. Now, the fact that we're transferring money between the funds has zero impact on the employer contribution, because to the extent it's not in police, we count it in the variable supplements fund.
But it's like paying my mortgage ahead of time. I got a savings somehow.
That may not be a bad way of looking at it in the following sense. If you have obligations and you know you've got them down the road and you want to finance them over the working lifetimes, you ought to begin paying for them. And that's exactly the approach we use in funding the police pension fund. I find the fact that, you still owe something later because you're still accruing liabilities and you still haven't paid it off, savings I'm having trouble with, but you are properly financing in anticipation of meeting the obligations of the variable supplements fund.
I got my answer. We paid our mortgage ahead of time. Okay.
Gee, we've only discussed this like it was like many years ago. We had this same conversation.
Exactly.
Okay. Anyhow, so I bring this to you today. The individual variable supplements boards will get separate letters, and I would hope, Mr. Executive Director, that the board might allow you to place these on the November board meeting for consideration of the resolutions to be adopted by both the main fund, this one, and the individual variable supplements fund boards for the other ones. I will have the other letters available no later than tomorrow. And as I say, the other issue that you may want to have a separate discussion on, either in executive session or elsewhere, is the particulars of just making sure you transition the money between one fund and another in the most efficient manner.
If I can make one very brief comment on this, as far as the operational procedural protocols to move the money, because we already have the rough dollar amounts. And as it turns out, for U.S. equities, we have, I don't know, I was going to say it's foresight in anticipation of this, but we have your U.S. equity Russell 3000 portfolios for both police and the police VSS, presently not for police superior, but will be reinstated for police superior, are commingled. So in the event,
You might, this might be a discussion.
This is strategy, you have to do this in executive.
Okay.
so what we're doing is we're moving ahead with a plan of action so that for superiors, money at the very least is there. Whether it's a total amount or not, it will be there. We'll true it up later. And for officers, the money's already there even before, but we're working up a plan of action, and we're going to be working with Barry and report back to the board on asset allocations going forward.
So, why don't we table this matter until all the documents have caught up, and you have a plan of action for the board, I'm sure before the next month's meeting. And that way you'll get all that information to the trustees prior to next month's meeting, and at least we can have the discussion, and then maybe vote on this at next month's meeting. The latest would be the December meeting, right, Bob? To vote on it?
I believe that the executive director and the administrators would like a little bit more time
Oh, no,
in advance
I
to
completely
be able
agree.
to plan and take care of all the things they need to do, and the controller's office will need a certain amount of time after even you've authorized, which is why it's hoped and suggested
For
that
next
you
month.
try to deal with it at the November regular board meeting, if that's the next opportunity to
Give it-
vote. That would give at least 4 weeks to 6 weeks for everybody to do what needs to be done.
So given the concerns expressed, then the hope is that we have all of this in the next, all this information next week or so, sent to the trustees, and then we can review it and then vote on it for next meeting. So that would be my take. Okay? Okay. Anybody want to second that? Okay. All right.
Thank you.
Is that a date for next month?
Yeah,
you
I
said
just
November,
wanted to
right?
confirm that all trustees have checked their calendar for the November investment meeting. We're hoping to do it the afternoon of November 5th, and Nicole had sent around an email, and I'm not sure we've confirmed it with everyone, but so far that's the date, and if anybody has any kind of conflict, please let us know ASAP. Otherwise, we'll move forward with November 5th.
And that's at 12:30?
Yes.
12:30.
There's a deferred comp in the morning, so we'll all be going to multiple meetings that day.
November 5th.
November 5th, 12:30. Yeah.
Great, thank you.
So that concludes our public session.
So I make a motion that we leave public session and go into executive session for purposes of discussing investments, transfer of assets, and other training materials.
Have a second? Second. PC, okay, 5 minutes to break down the cameras?